Well, thank you for having us here today. I'm Jasdeep Hansra, and I'm joined by my colleague Lukas Ahnert, and together we're representing DWS. We are a German headquartered large asset manager with investments across traditional active, alternatives, and what we're here to talk about today, which is our Xtrackers ETF business. Looking back into 2022, it was a very interesting year for US equities. We saw for the first time in years that interest rates were increasing, and obviously that had an effect in terms of valuations and the knock-on into equity markets as well. Coming into 2023, the picture has somewhat reversed, and we've seen that a small number of stocks have driven a large performance of US equities. Much of that is driven by AI and the rise of new productivity and new tools which we will see develop in the coming years. From a macroeconomic standpoint, the economy remains resilient. We see, of course, that interest rates will take time to pass through into the real economy, but data that's come through in the US has been strong and equity markets have responded accordingly. Looking forwards for the rest of 2023, there are a number of different aspects that we should consider, and of course the integration of Fed policy, interest rates, economic growth and investor positioning mean that the US equity market, the largest in the world, is something that needs to be looked at and addressed through a finer lens.
So overall, US equity performance has been very resilient this year, despite the risk scenarios that we still saw in the beginning of the year. If we look into one of those core US indices, the S&P 500, capturing the largest 500 companies in the US, that index is up about 20% on a year-to-date basis. And also if we look into the MSCI equivalent, the MSCI USA, that index has also fared fairly well. It's also up about 20%. Now, if we look into some of those other also very broadly followed indices, the Nasdaq 100, for example, or the Russell 2000, we see very different performance across those indices. The Nasdaq, the typical tech index, is up about 40% year to date. It's the strongest start of that index into a calendar year since 1983. The Russell, on the other hand, actually underperformed those indices. The Russell 2000 is a mid and small cap index capturing 2,000 stocks, but actually the performance this year has been only about 15%. So there's a big dispersion here in the performance, and the big question, of course, is what is the driver behind it? And actually, if we look under the surface, it's a rather straightforward story. It's a small number of consumer tech stocks in the US that has done incredibly well in terms of performance this year. And many of these names are already the largest index constituents across those indices. Now, that also means when we explain the performance, there are basically two indicators that are most important. On the one hand side, it's the weight of the information technology sector. The more the index is allocating towards that sector, the better the performance actually this year has been, simply because that sector performed so well. And the other important consideration is actually the idea of concentration. And we can measure that, for example, by looking at the weight of the top 10 stocks in an index. The more heavily concentrated the index, the more it is exposed to these very large mega caps that have done so well this year, and that also contributed significantly to performance. So analyzing concentration at the index level is actually becoming more and more important, simply because indices these days are becoming more and more concentrated. That's one of the big trends over the last couple of years. Now, this year is also a good illustration actually of some of the pros and cons of investing into those highly concentrated indices. On the performance side, we've discussed the S&P 500 already. If we were to strip out those effects of concentration and look into the so-called S&P 500 equal weight index, so an index that equally allocates to each of those stocks, performance would have been very different and actually a lot less than what we've seen in the S&P 500. So there are a lot of proponents of those heavily concentrated indices these days because they do reflect some of the underlying economics of many of those sectors that we're covering. In the tech space, for example, there is this tendency of a winner takes it all move, and so this is also getting increasingly reflected in indices. Now, on the contrary, one has to be mindful that over very long periods of time, there's the tendency that the average stock tends to fare better than a concentrated index. So a little bit of rebalancing may make sense. And that is also actually one of those considerations for the second half of the year now, because there are two predominant risk factors that investors should be mindful of. On the one hand side, it's the single stock specific risks that are significant. So on the year-to-date performance this year, it's been mostly 7 stocks that contributed most to the S&P 500 performance. There's also, of course, a risk associated to those 7 stocks going forward for the second half of the year. And the other big observation is, of course, on valuation itself. So a lot of the developments we've seen are based on forward expectations of companies and not so much realized earnings. And that opened up a broader valuation gap between the top stocks and the average stock in the index. So going forward, investors on the one hand side may want to assess concentration on the index level, and the top 10, for example, is a good first assessment of that. And in a second step, they may then want to think about ways to managing concentration in some of those increasingly concentrated indexes. So the most radical approach to manage concentration we've just discussed. It's the idea of equal weighting stocks. But investors have also explored other avenues to manage the concentration of indices. And actually using sectors has been incredibly popular the last couple of months. So sectors can be used in conjunction with an existing capitalization weighted index to adjust the weight that some of the sectors play and also thereby adjust the weight that some of the single names play. So that results in a much more diverse composition. Now, other routes also include factor-based investing. So factors can be used to adjust the weights of companies, and similarly, a thematic lens is increasingly taken by investors to also adjust the weight of companies and move away from a pure size weighting of companies, but also look into other metrics that are relevant, all with the intention to basically diversify the drivers of performance and the drivers of risk in those indices.
Well, we've talked a lot about different indices, and fundamentally, what does that mean? Well, it means that there are very different ways that you can choose to invest. And the Xtrackers ETF range by us, by DWS, is available in many forms on the AJ Bell site. And investors have the opportunity to look at the standard S&P 500 or MSCI USA, the equal weight products that Lukas mentioned, and also drilling down into individual sectors and factors, as well as thematics. So Xtrackers has the granularity and has the opportunity for investors to choose exactly how they want to put on their exposure to US equities. Finally, over the last 10 to 15 years, it's been really difficult for active managers to outperform the large indices in the US. And as a result, we are trying to give clients the opportunity to make their own decisions about where they want to be investing within this market.